Thank you very much for having me here. So in the next 20 minutes, we're going to share with you our view on global macro outlook, policy outlook, together with China's trade trajectory. So before our slides is ready, probably we should be here to just give you an overview. So in 2024, we are in general looking for a moderation of global growth. And after a rapid period of trade expansion, this pace of growth will also likely to slow down. And under the our first page is here. So our first page shows you the broad growth trajectory for 2024. So we are looking for a small moderation of global growth in 2024 on the back of a period of unprecedented and coordinated monetary policy tightening across all major central banks in the world. And this has already led to a substantial tightening in financing conditions, and we have seen credit impulse slowing down materially across major Western markets. And for the case of China, we're also seeing an ongoing round of rebalancing of the Chinese economy, and this round of the pressure, especially from the real estate sector, might not have been ended. So net, on the back of a higher base this year, we do look for China growth to slow down a little bit in 2024. So out of all these major economies, the only exception comes from the Eurozone, which started to weaken quite a bit ahead of their global peers. And because of a much lower base, and the possibility for slightly better external demand for European goods next year, we are looking for a small rebound of the European economy. But let's first look at, again, the US. US economy has been constantly surprising on the upside so far this year and has so far still been growing above trend. We are looking for a moderation and a normalization back to trend or slightly below trend because of the strong fiscal related boost to the domestic, especially household consumption, services-related economic recovery. It's now likely coming to a late stage. And at the same time, the substantial rise of the long-dated bond yields has also led to an additional layer of monetary policy tightening and the tightening of financing conditions. With inflation in major Western markets already coming down substantially, we do expect a turning point of monetary policy globally. So on one hand, we do see selected DM markets continue to stay afloat, or especially for the case of the United States, continue to surprise on the upside. But from an inflation's perspective, all indicators have been coming down. But having said that, we are not expecting any of the major economies to have their inflation goal returning to their long-term target before 2025. So what that means is that we will likely to see, a tipping point that we are already hiking to late stage, or for major economies in our view, including both the United States, Europe, major DM or G10 currencies, including sterling as well, have already reached their peak of interest rates. But on the other hand, the decline or the rate cut trajectory will also likely to be very, very slow and modest. At the same time, we're showing you two charts here. The chart on the left-hand side is major DM market policy rates as well as their trajectory. On the right-hand side, it's major EM economies. We started to see quite a lot of divergence. In the DM world, it's more about hiking to the late stage, but the easing, it's quite a bit ahead of us. But in the EM world, that's another story. We started to see major EM economies across Latin America, Central Europe have already started to cut rates quite decisively. But conversely, here in Asia, we just got two surprise hikes from Indonesia as well as Philippines. So the renewed currency pressure, which lead to some renewed inflationary pressure in regional economies, will likely lead to continued divergence across the EM world. In general, under the context of China, we hold our view that China rates is a lower for longer story versus DM rates, a higher for longer story. And on the back of these is a complete divergence of global inflation. From China's perspective, we will likely to see a period of sustained structurally low inflation on the back of a number of factors, including relatively weak local demand, some emigration of the labor-intensive production capabilities. And at the same time, what has been largely ignored by nearly all the investment community is the synergy created on the back of a very strong round of localization and integration of domestic supply chains that's finally coming up to become effectiveness of production and synergy. But on the other hand, DM inflation, as we can see in more details from both of the case in the United States and Europe, would be supported by relatively strong household balance sheet, and that's a result of the different usage of fiscal resources during the period of COVID. For the case of US, so if we look at the chart on the left-hand side, this is what market is currently pricing in for the Fed to be acting next year. So what we have seen is the Fed hiking since March last year consecutively by 525 basis points. And now if you look at the rate cut expectation, we are already on the relatively more bearish side when it comes to US economy and therefore when it comes to the Fed's action. We are only looking for 50 bips of cut in 2024. So from the market's perspective, the long-term rate expectation, even by the end of 2024, it's well above mid-4%. So from this perspective, it means that the underlying inflation momentum will likely to stay there. And one of the key explanations, it's a still very, very tight labor market. We started to see the first sign of weakness in the US labor market with unemployment rate bouncing back to 3.9%. But if you look at the chart on the upper right-hand side, this 3.9% stays well at the bottom in the last 70 years. So we still have a very tight labor market. At the same time, household balance sheet in the States is the strongest in a decade, if not longer, due to unprecedented also fiscal stimulus during the period of COVID. As such, wage increase are still above 4%, which means it's very difficult for the Fed to be able to get its core inflation target back to the long-term 2% target anytime soon. So any rate cut will likely to be gradual, although we have already reached the turning point. For the case of Europe, European economies has obviously weakened much earlier compared with its US peers, if you can look at the PMI indices on the right-hand side. For major European economies impacted partly because of the Ukraine-Russia war and due to energy shortage, energy disruption, and therefore a emigration of major manufacturing capabilities. We have seen, for example, Germany's PMI, manufacturing PMI declining to 40, and the bulk of the Eurozone's PMI as well below 50 line as well. So we do expect the ECB to act much faster than the Fed. We now expect the ECB to start cutting in the second quarter of next year, and we do not rule out the possibility for the ECB to start cutting as early as March. But having said that, again, when we look at Eurozone inflation, there are a lot of structural stories, and especially indeed in the entire Western world, what we have seen is that everyone, when they are talking about de-risking from China, the reality is that everyone is willing to pay up for safety, pay up for security. That means this world is no longer operating under an efficiency model. If you're no longer efficiency first, costs have to go up. So structurally, we see Western inflation staying structurally higher in the foreseeable future, despite this round of the unprecedented monetary policy tightening. And after these, we finally get to China. So if you look at the chart on the left-hand side, this is not our forecast. This is the consensus forecast by the market. So after a period of consecutive downgrade of China GDP for both 2022 and 2024, expectation is finally stabilizing. From our perspective, there is a chance for upside surprise for the fourth quarter GDP simply because consensus is now being too conservative. Based on our forecast, we have already started to see a stabilization of China growth starting from August and then lasting into September. This round of the recovery has not been very strong, but at least we believe we have already seen the bottom. So for the fourth quarter, we see headline GDP likely to come out at around mid-5% or even slightly above that versus market consensus of only 4.9. And even under such a soundingly very benign expectation, the sequential growth when it comes to the third versus the fourth quarter is already slowing down. So we also believe that this is still a relatively conservative expectation. Then if we look longer, One of the most important things to understand China policy and therefore the economic trajectory from here is a complete change of policy-making protocol after the Party Congress. If you look at the chart on the right-hand side, we simply do a world count, and I believe nearly everyone have done that after the Party Congress. So the keyword or the word count of security exceeded economy or development for the first time. Initially, we don't know what that means. We sort of got a sense that security is becoming more important. But getting into the second and the third quarter of this year, we believe our investors start to get a much better understanding of what this actually means. Since the second quarter of this year, what we have been receiving from our global investors as the most frequently asked question is that why the Chinese government has been piecemeal when it comes to the stimulus to the real estate market, why it has been refraining from stimulating the economy in a much stronger way. So let's now look at timing and look at the world that we are having now. China domestically have a very strong political environment after the Party Congress. Outside of China, geopolitical risk is getting higher, and things has been worsening than what had been expected. Although we do expect a period of stabilization or even better improvement of China-US relationships in the short term, but in the medium to long term, the competitive landscape stays unchanged. And therefore, from this administration's perspective, safety is much more important than the ability to be able to grow at the maximum rate. And therefore, we should be expecting two directions of monetary policy, of overall economic policy making from here. The first direction is simply de-risk. We have seen them de-risking from the real estate sector, looking to de-risk from local government debt issues, and now financial safety is being brought up at a much higher priority at the meeting just held last week, the Central Finance Work Conference. And the second direction would be supporting anything that can facilitate China's long-term sustainability in growth and reduce China's vulnerability in their dependence to the rest of the world. When the rest of the world keep talking about de-risking from China, becoming less dependent on China, the opposite has also been true. When you start to feel the risk that you might not be able to purchase something in the future, such as chips or semiconductor, the immediate reaction should be, I would want to be able to make everything myself. And that has been driving a strong round of localization over the last few years. So from a overall growth perspective, we do expect headline GDP to moderate slightly to the 4% handle in 2024, partly because of a much higher base. And one of the primary reason remains to be the real estate sector. So under the current de-risking or relatively defensive policy making environment, it's highly unlikely to see a very strong boost to the real estate sector. The goal is to de-risk, is to avoid the sector getting into systematic risk. The goal has never been trying to revive the sector so that it become a primary growth engine anymore. As such, we have seen a round of real estate stimulus, but the bulk of these stimulus, it's aiming to only stabilize this sector. When we look at home sales, look at leading indicators such as land sales, we have not really seen any meaningful recovery, yet it's no longer in free falling anymore. And therefore, real estate sector will likely to remain a drag to China economic growth for the time being. And in the coming few quarters, we do not expect real estate to turn around to become a growth driver anymore. And on the trajectory, we should still see quite a lot of economic strength coming elsewhere. So first, we try to compare the three major real activity data's performance versus the pre-COVID trend. The first, we have IP, and then investment, finally retail sales. So aside from IP, on the back of a very strong round of export demand, strong external demand during the peak of COVID, IP is indeed growing above trend. And what's more is that there has been a sharp change or sharp reallocation of financing resources away from the real estate sector and into the manufacturing sector. What we are not showing here, but if you're interested, you can take a look at the chart, is that if you look at the banking sector credit extension, the portion to the real estate sector has been tanking from north of 5 trillion just before COVID to literally zero this year. On the flip side, the banking credit extended to the industrial sectors went from about 0.6 trillion ahead of COVID all the way to north of 4 trillion today. So there has been a huge divergence, and part of the reason of that is because of a more defensive stance. I would like to have everything in my supply chain to safeguard my supply chain, and the result is a much stronger IP. But on the flip side, real estate sector as a sector have a very long train effect. And on the back of weaker real estate sector, we have seen real estate FAI was down 10% last year, but still down by 9% so far this year. And that has been one of the primary drag to China investments. And at the same time, its cascading impact into retail sales consumption has also been obvious. For example, retail sales for the moment is still very far away from the pre-COVID trend level. But once you break down China's retail sales, you'll find that the worst performer has been home decoration, furniture, housing, electronic applicants, everything that's related to the real estate sector. So going into 2024 or even 2025, we see a continued recovery in these segments, especially a more proactive fiscal policy will likely to bring back incremental infrastructure investment and therefore offset the loss from the real estate sector. And so from a growth perspective, we do look for decent pace of growth, but it's highly unlikely to see an overheating situation. And as we mentioned earlier, under such an environment, we will likely to see an extended period of structural low inflation in China. One is that if growth remains subtrend due to the pressure from the real estate sector, domestic demand may not return to trend in the near future. And together, as we discussed, we have this localization leading to greater production efficiency and some emigration of the low-end labor-intensive production outside of China. We will likely to see some period of overcapacity leading to an extended period of PPI being negative, and it also constrains the CPI's trajectory. So from here on, we do expect the biggest period or the deepest period for the deflationary pressure is now behind us. From the CPI inflation's perspective, we see a gradual rebound, but probably more like towards 0.5% by the end of this year. And throughout the entire 2024, we still see headline CPI inflation stay comfortably under 2%, which remains quite a bit lower than the government's long-term target of 3%. For PPI, because of the persisting overcapacity, we don't see PPI returning to positive until at least the second quarter of next year, and will likely to stay relatively modest for the remaining of 2024. So from this perspective, it's highly unlikely to see inflation being one of the determining factor when it comes to China's monetary policy towards the tightening side. As such, from a monetary policy point of view, we see continued easing from here. So unlike what we have seen in the Western economies, where we have seen this unprecedented round of rate hikes, from China's perspective, we feel monetary policy is more likely a trajectory of ease, pause, and ease further. First of all, real rates remains too high simply because there's no inflation. So if you look at this chart, on the left-hand side, we try to compare China's real rates using the simplest model. We simply subtract headline CPI from 10-year Treasury bond yield. So the red line represents China. So from a historical patterns perspective, compare with China themselves or compare with their global peers, China real rate is the highest, or at least one of the highest in the world. And very counterintuitively, we have seen rounds of monetary policy easing, including MLF rate cuts, triple R cut, and indeed we're looking for another imminent triple R cut ahead. But what we have seen in the banking sector when it comes to average cost of liabilities is the chart on the right-hand side. So these would be factual numbers instead of forecast. We just take the average of the 42 listing Chinese banks. And very counterintuitively, the overall cost of funding, especially the cost of funding from deposits, has been rebounding substantially to almost the highest level over the last 5 years. And that has a lot of technical reasons, such as a strong wave of returning to balance sheet from the WMPs, or wealth management product proceeds, and everyone wants to do term deposits. So from our banking sector's perspective, they are now facing a rise of cost pressure at the expense of extension of duration of their liabilities. So under such a situation, what's needed the next would be another cut of China's deposit rate. And following that, we do expect to see more monetary policy easing, including triple R cut, MLF cut in the quarters ahead. And since we are in a shipping conference, we would also like to discuss trade. We believe there has been a lot of discussion, but yet our study probably would be here to provide a bit more evidence. Some of the changes could be structural in our view. So first of all, if anything, we are very bullish at China's manufacturing sector. And at the same time, that will likely cascading into China's export performance, export strength. And partly due to this great movement on localization, imports could stay structurally weaker, and imports should no longer be reading as China's weak domestic demand, or weak imports should no longer be interpreted as China's weak domestic demand. So first of all, we can take a look at the performance this year. So from a values perspective, China's imports has been declining faster than China's exports so far this year. But once we decompose these numbers, quite a lot of the changes are actually driven by price instead of quantity. So for example, it's well known that China's export growth has been moving to the negative territory because of a very high base last year. But if you look at the right-hand side, the bulk of the decline is driven by price, the red bars, instead of quantity. So when it comes to export quantity, it has already started to rebound, and it has been rebounded quite maturely over the last 2 to 3 months already. But price has been coming lower, partly because of domestic competition due to fears over capacity at home. And under such a situation, we have already seen a sharp change of global shipping prices. The font could be a bit small, but let me explain this chart. So when we look at the major shipping routes in the world and compare the price at 3 points, one is pre-COVID. The second bar is the peak of COVID, i.e. the period when you see peak pricing. And lastly is the latest pricing. So across all the major shipping routes in the world, with the exception of Europe to the west coast of South America, all the other routes have seen price dropping very decisively, well below their pre-COVID level. So that, on one hand, reflected a overcapacity build up during COVID, and once logistics become more smooth, that a lot of the capacity got unleashed, and therefore lead to lower price. But at the same time, it also suggests that globally, trade has indeed been declining. But when we look at China's situation themselves, one chart, I don't have it here, is that it would be interesting to look at China's share when it comes to its export share to the world export share. By now, China has already given up the additional gain during COVID and returned to pre-COVID level. But once we try to figure out who they are losing market share to, it's not to the other manufacturing countries. The only one that has been gaining market share from China are purely commodity countries, including the US. And for the major manufacturing competitors, ranging from the likes of Germany, Japan, Korea, their market share has actually been declining and has not really taken back market share from China. And from China's perspective, we are also aware of a change of export destination. For example, these charts shows that the export destination are incrementally leaning towards a new area, including the Belt and Road countries. For example, in the left-hand side, you see the Belt and Road countries already account for more than 45% of China's exports. And on the right-hand side, once you try to decompose the growth of China's exports, you would also find that the bulk of the incremental demand come from places like Russia, Middle East, Central Asia, Latin Africa. For China's direct trade with the US, it has been declining, but if we include the indirect trade through ASEAN, India, Mexico, it's basically staying the same. So what that means is that there has been a rotation of direct trade counterparties, but when it comes to external aggregate demand, the change has not been so visible. And at the same time, as there has been lots of effort and discussion talking about de-risking from China, i.e. the emigration of supply chain out of China, and we would like to see what impact there has been. And surprisingly, our study found that the impact has not been material. It's simply changing from China's export of completed goods towards the export of interim goods. For example, if we focus on the first chart here, we try to compare the imports of the import performance of China's major exporting destinations, i.e. EU, ASEAN, and US, versus China versus their so-called +1 countries or competitors. The net result is that China's export performance has outperformed the import performance for many of its major importing destinations, notably ASEAN and Europe. And second, compare with nearly all the +1 countries, with the exception of Mexico, China has outperformed all. For example, both Vietnam, India are down double digit, and China is down by under 6%. So from this perspective, and incorporating what the corporates has been telling us, is that people are merely moving outside the final stage of assembly. Because US market is too big and too important, tariff is new. So it does make sense for them to move the final assembly procedure outside of the mainland China. You save labor cost, you more importantly save tariff. But on the flip side, nobody at this moment is moving much of their supply chain, especially if you recall, shipping costs has come down. And by comparing local suppliers or alternative suppliers, the conclusion would be as such. The local suppliers are too weak when it comes to quality. The local foreign suppliers are very costly. And the Chinese suppliers, once shipping cost is coming down, remains the most economical from a price versus quality point of view. So under such a situation, we see a relatively modest impact to China's overall export performance, at least in the foreseeable future when it comes to the emigration of supply chain. Although we do not believe that now we have come to an end of that, but the overall competitiveness when it comes to the supply chain integration at home will likely to empower China's manufacturing sector to be able to gain more ground globally. And finally, when it comes to overall trade balance, we feel that China's trade balance is a structural story instead of a cyclical story. If you look at the chart on the left-hand side, I think last year it was well known that China's trade surplus was all-time high, and it has been very outstanding under a global context. And this year, I think what surprised people is that on the back of such a bearish expectation, bearish sentiment, China's trade surplus is actually on par with last year's all-time high level. And from our perspective, this would be a structural story. There are two fronts. On one hand, as we discussed earlier, there has been a stronger, a high allocation of resources into the manufacturing sector, and that has led to better efficiency and therefore stronger competitiveness. So we have seen, for example, in the auto sector, China was still a net importer of cars 2 years ago, and this year it became a net exporter of auto. And this is a reflection of competitiveness rather than anything else in our view. So this is the first part. So from export perspective, competitiveness is going to gain more market share. And the flip side is on the import side. Because of the fear factor, because of the fear that something might no longer be available one day in the future, they are actively trying to make up all the holes, and the localization, it's gaining momentum. So if you look at the flip side of the story would be chips. the bottom chart on the right-hand side, China's chips import is down 20%, nearly 20% each year. And before this round of the episode, if you decompose China's imports numbers, China's import for chips or payment for chips has well exceeded China's payment for crude oil to become the largest item across all importing items. Now, why this is down? There are obviously two fronts of the story. For the very top-end chips, such as AI chips, it's impacted by the US ban. But on the flip side of the story, what people have ignored is the replacement by local suppliers because of the localization and because of the additional resources that's put in place. So on the back of such a situation, we feel that structurally, China's imports will be weaker, partly because of localization, and exports will likely to maintain relatively strong market share because of the strong competitiveness. So from here, we remain very constructive when it comes to China's trade and manufacturing sector outlook. So I think I've come to the end of my presentation. So just to summarize the key message we have here. We are looking for a moderation of global growth and a turning point of global monetary policy from here. From China's perspective, we see the country going through a period of extended transition to move out of its old growth model, out of real estate and into something new and more sustainable. And from this perspective, we remain very constructive on China's trade and exports outlook. Thank you very much.